Welcome to The Other Opinion. This is the channel where we really dig into those perspectives that maybe aren't talked about as much, the ones that might even seem a bit scary or counterintuitive. And today, we're doing just that. We're taking a deep dive into a financial strategy that honestly goes against the grain: forgettable long-term investing. You know, everyone seems obsessed with daily charts, reacting to every little market flutter. But what if the better way, the path to real wealth, is putting money into solid growth companies and then, well, forgetting about it for like a decade?
Yeah, it sounds almost too simple, right? But that's the core idea.
Yeah.
And our main source for today's discussion is a guide from 2025 called Top Companies for Forgettable Long-Term Investing. It really lays out the case for this approach: lump sum investing, long-term holds using historical data, and some pretty interesting forward-looking analysis.
Okay, this definitely sounds like an other opinion worth exploring. So if you're intrigued, please do hit that like button for this deep dive. And we really want to hear your other opinions down in the comments. Make sure you subscribe to the Other Opinion channel too, so you don't miss our future explorations. Oh, and share this. Share it with someone you think needs a different angle on investing. All right, let's get into it. This idea, long-term lump sum investing. Can you unpack that a bit? What is it exactly, and why does the evidence suggest it often beats trying to, time the market perfectly, especially over 10 years or more?
Well, the beauty of it is its simplicity, really. It means taking a significant chunk of capital, your lump sum, and putting it into companies or maybe assets that are fundamentally strong. And then you just let it sit. Let time and compound growth do their thing. The source points out, historically, just putting money in the S&P 500 and leaving it would get you maybe 7 to 10% compounded annually. But the way to really supercharge that, as the source calls it, is by picking specific winners, companies that have these really strong economic moats.
Moats. I like that. Like a castle's defense. Keeps the competition out.
Exactly like that. It's about durable competitive advantages. Things like incredibly strong brand loyalty, maybe cutting-edge tech leadership that others can't easily replicate, or those super valuable recurring revenue models. These are the qualities that give a company resilience. They make it the kind of investment you can realistically forget about for 10 years because their foundation is just so solid and their growth path seems, well, pretty well set.
Okay, this is where it gets really interesting then. Our source names names. It points to specific companies, mostly the big tech players, right? The ones dominating AI, cloud, consumer tech.
Yeah.
Some with market caps already in the trillions.
That's right. We're talking about absolute behemoths. And the source didn't just pick them for their size today. It's about their track record, robust earnings, consistent growth, and crucially, their deep investment in innovations that look set to define the future. They're the bedrock in many ways.
And right at the top, the biggest of them all right now, NVIDIA, the AI chip kingpin. What makes NVIDIA such a prime candidate for this set-it-and-forget-it approach?
Oh, NVIDIA. It's pretty staggering. A market cap around, what, $4.4 trillion? They made that incredible pivot, didn't they?
Yeah.
From primarily gaming graphics cards to basically powering the entire AI revolution. If AI is the new electricity, NVIDIA is building the power plants. Their recent numbers are just huge. Q2 fiscal 2026, ending July 2025, revenue over $30 billion. That's up 122% year over year.
Wow.
And the driving force, data centers, $26.3 billion in revenue from that segment alone, up 154%. It's all driven by this insatiable demand for AI processing from the big cloud providers, the hyperscalers. AI is now like 87% of their total revenue. It's incredible.
So what's the look ahead, the 2030 view?
The projections are pretty wild. Analysts see global AI spending hitting $1 trillion annually by 2030. And NVIDIA, they're expected to keep dominating the high-end chip market, capturing maybe 75 to 90% of it. Plus, their new Blackwell chips are coming later this year, supposed to be 4 times faster. That opens doors for even more growth in things like robotics, quantum computing, AI at the edge, autonomous vehicles. Their drive platform is a big part of that.
So for the investor just putting money in and walking away for a decade?
The case is compelling. Yes, the dividend is tiny, almost non-existent, but they do buybacks, which shows confidence. The source even suggests, based on past performance, that $10,000 invested now could potentially become over $60,000 in 10 years.
Okay, but what about the valuation? A PE ratio of 70x sounds really high.
It does sound high, yeah. But with this kind of projected growth, sometimes those high PEs are seen as justified. The strategy here, especially with a volatile stock like NVIDIA, remember it swung like 50% in 2024, might be to buy on dips. People who bought during the 2022 dip saw amazing returns, like 10 times their money. And their moat It's not just the chips, it's the CAD software. That whole ecosystem makes it really hard for competitors like AMD to catch up easily. It's sticky.
Right, that software lock-in is key. Okay, moving from the chip king to maybe the ultimate software and cloud giant, Microsoft. This one just feels like a bedrock stock. Why is it such a reliable fit for the forgettable model?
Microsoft is a masterclass in evolution, isn't it? Around $3.5 trillion market cap now.
Yeah.
They went from Windows dominance to this absolute powerhouse in Azure Cloud and Office 365 subscriptions. Their latest quarterly revenue, fiscal Q4 2025, was $76.4 billion, up 18%. Net income, $27.2 billion. And Azure, their cloud platform, grew 34%. It's now pulling in over $75 billion a year on its own, and that's getting a huge boost from AI features like Copilot being integrated everywhere.
And their other businesses are still strong too.
Yeah. Productivity tools, even Xbox gaming, all contributing. It's a really well-rounded picture.
So, looking out towards 2030 for Microsoft.
The source floats a potential $5 trillion valuation by then, the drivers. Think AI agents becoming standard in basically every app. Progress in quantum computing through Azure, maybe even more serious moves into the metaverse, whatever that ends up looking like. They're forecasting steady earnings growth, maybe 15% annually. And the key is that recurring revenue subscriptions make up something like 90% of their income now. That's predictability.
And for the investor.
It's almost the poster child for set it and forget it. You get a decent dividend, around 2.3%, consistent large share buybacks, that $10,000 answer. At 15% compound growth, it could turn into $40,000 by 2035.
Any major risks? Antitrust is always hanging around them, isn't it?
It is, yeah. That's always a shadow for big tech. But Microsoft's diversification is a huge buffer. Cloud is about half their revenue, software maybe 30%. It's not like they have all their eggs in one basket. That helps cushion things.
Makes sense. Okay, let's talk Apple. Timeless appeal, incredible brand loyalty. Feels more like a luxury goods company sometimes. How does that whole ecosystem translate into a forget-it investment?
Apple's huge too, of course. Around $3.45 trillion market cap. And you're right, the iPhone built the empire, but the future, and a lot of the current excitement, is around their services. Their latest quarter, Q3 fiscal 2025, revenue hit $94 billion, up 10%. Services jumped 13% to over $27 billion. That happened even with a small dip in iPhone sales, which shows the power of that services segment. Wearables and Macs are growing too, especially with their own silicon chips.
And the future. What's the growth story beyond the next iPhone?
Well, Apple Intelligence, their big push into AI features, is expected to trigger a major upgrade cycle. That could push their annual revenue towards $500 billion. Plus, they keep expanding. Health features on the watch, rumors about AR glasses persist, maybe even an EV down the line. And the margins on services are fantastic, around 70%. Super profitable.
So for the long-term holder,
Apple offers a solid dividend, about 2.5%, and just massive share buybacks, often over $100 billion a year. Using that $10,000 example again, at a projected 10% growth, it might become $26,000 by 2030.
what about risks? China seems like a potential headwind sometimes.
It definitely is a market they watch closely, but the sheer scale of their ecosystem, over 2 billion active devices worldwide, creates this incredible lock-in. People are invested in the ecosystem, which makes the brand incredibly sticky. That's gold for long-term investors.
Right, that ecosystem loyalty is powerful. Let's switch gears slightly to Amazon. It's got that split personality, massive online retailer, but also the dominant cloud player with AWS. How does that diversification work for a long-term, forgettable hold?
Amazon's fascinating. Market cap around $2.2 trillion. They started in e-commerce, obviously, but AWS, their cloud division, is now the real profit engine. Q2 2025 saw revenues of $167.7 billion, up 13%. AWS grew 17% to almost $31 billion. E-commerce was up 11%. And importantly, they're getting much more efficient, netted over $18 billion in profit that quarter.
And the outlook for AWS and beyond.
AWS could be a $200 billion annual business by 2030, especially as they roll out more AI tools like Bedrock. Amazon's also pushing into healthcare. Their advertising business is already huge, like $50 billion a year now. And they're big in robotics, too. They're looking at maybe 15% compound annual growth overall.
So why forget Amazon? What makes it fit?
That diversification is key. Retail is maybe 60% of revenue. Cloud is almost 20%, plus ads and other things. It makes them really resilient. They don't pay a dividend, which some investors don't like.
Right, they reinvest everything.
Exactly. They plow profits back into growing the business, which is great for long-term capital appreciation. That's why, despite the ups and downs of retail, it's seen as a solid long-term winner for this lump sum strategy.
Okay, next up, Alphabet. We mostly still call it Google, right? Search is just so dominant. Does that sheer dominance give it the staying power for a forget-it portfolio?
Absolutely. Alphabet's over $2 trillion in market cap. Their core business is incredibly strong. Q2 2025 revenue was $96.4 billion, up 14%. Search was up 14%. YouTube ads up 13%. Just steady, powerful growth. Looking out to 2030, you've got growth from their Gemini AI models, Waymo autonomous cars potentially becoming a real business, and Google Cloud aiming for $100 billion annually.
But ads are still the main driver.
Oh yeah, advertising is still about 3/4 of their revenue. It's the engine. But these other bets offer future growth potential. For investors, they actually started paying a small dividend in 2024, about 0.5%, and they generate enormous amounts of cash. Definitely a core holding for this kind of strategy.
All right, what about Meta? Facebook, Instagram, WhatsApp, plus the big metaverse gamble. Is Meta truly forgettable material like these others?
Meta is an interesting case. $1.5 trillion market cap. They've definitely shifted focus towards AI. Their Llama models are significant, and of course, virtual reality with the Quest headsets and the whole metaverse concept. Financially, they're doing well. Q2 2025 revenue hit $47.5 billion, up a strong 22%. EPS was impressive too at $7.14. Advertising's still paying the bills big time.
And the future bets. Metaverse and AI.
That's the plan. Getting Quest VR mainstream by 2030 is a goal. They also really focused on efficiency after those layoffs in 2023, which investors liked. It makes them maybe a bit more solid for a lump sum approach now, but you have to accept the higher risk tied to whether that metaverse vision really pans out.
Okay, now for maybe the most controversial one for a forget-it strategy, Tesla. It's so volatile. Can you really just buy it and ignore it for 10 years?
Yeah, Tesla's the wild card here for
Right.
sure. Market cap around $830 billion. Q2 2025 revenue is actually down 12%, hitting $22.5 billion, with net income around $1.17 billion. So, yeah, volatility is the name of the game.
But the long-term story.
That's where the forget it angle comes in, but with a big asterisk. The 2030 outlook hinges on massive disruption. Robotaxis becoming a reality, and their energy storage business absolutely booming. Many analysts think the energy side is hugely undervalued. So the source basically calls Tesla a high-risk, high-reward play specifically for the forgetter. You have to really believe in Musk's long-term vision for autonomy and energy and be willing to ride out enormous swings. It's a conviction bet, not for everyone.
Got it. High conviction needed there. Lastly, a name maybe fewer people know intimately, but it's crucial. Broadcom. What's their forgettable case?
Broadcom's a semiconductor and software giant, market cap near $800 billion. They make critical components for networking, broadband, wireless, basically the plumbing of the digital world. Q2 2025 revenue was $15 billion, up 20%. Their growth is tied to really durable trends like the build-out of AI networking infrastructure. Plus, they recently acquired VMware, which massively expands their enterprise software business. And importantly for this strategy, they're known as a stable dividend payer. That adds a layer of appeal for long-term passive holding.
Okay, so that covers the big tech and chip players.
Okay.
But the source didn't stop there, right? I mentioned digital assets. Now, that's another opinion for diversification. Seems risky for forgetting.
It definitely is a higher risk category, no question. But the source includes them for potential diversification benefits, suggesting maybe a small slice of the portfolio, like 5 to 10% for long-term hold. Bitcoin, for example, trading over $100 K in 2025. It's increasingly seen by some as digital gold, a store of value. And the new Bitcoin ETFs make it way easier for regular investors to get exposure.
And the outlook there.
Some projections are looking at $1 million per Bitcoin by 2030, fueled by more institutional money coming in. It's a big if, but that's the potential. Then there's Ethereum, the platform for smart contracts and DeFi. Upgrades like Denkun are making it cheaper and faster. The outlook there could be $10,000 by 2030. Solana's another one, super fast, low fees, getting traction in gaming and NFTs. Potential for $500. XRP is mentioned for payments, especially after some regulatory clarity. Arbitrum is a layer 2 for Ethereum, helping it scale.
And others, too.
Yeah, brief mentions of BNB, Polkadot, DOT, Cardano, ADA, a few others. But the key point is diversification within a small allocation.
What about the risks? Hacks, regulation?
Huge risks, absolutely. Regulation is constantly evolving and security is always a concern. For the forgettable strategy, the suggestion is maybe using diversified crypto ETFs rather than holding individual coins directly. It simplifies things and spreads the risk a bit.
Okay, so we've covered these tech titans, these potential future giants, and even a slice of the digital asset world. Let's pull it all together. What's the main takeaway for you, the listener, who's maybe tired of the constant market noise?
I think the big picture here is that these companies, and perhaps these digital assets, are fundamentally aligned with major future trends: AI, cloud, digitalization, the crypto economy. The strategy itself, this forgettable long-term investing, is about harnessing that growth. You make a significant investment upfront, the lump sum. You diversify across these strong players, and then you practice patience. Serious patience, like a decade or more. The potential returns come from letting that compound growth work its magic over a long period. It really is like planting that tree, as you said earlier. You trust the process, you don't keep digging it up.
It's such a contrast, isn't it? In a world yelling, act now, react, buy, sell. Maybe the most radical and most powerful thing you can do is nothing. Just thoughtful selection up front, followed by disciplined patience. So here's a final thought for you. What other opinion do you hold about the path to long-term financial freedom? Does this invest and forget idea resonate, or does it feel completely wrong? We really hope this deep dive gave you something valuable to think about, a different perspective perhaps. If you found this exploration into the other opinion useful, please give us a like. And definitely share your other opinions on investing down in the comments. We love reading those. Make sure you're subscribed so you catch all our future deep dives. And hey, share this with a friend, maybe someone overwhelmed by market news. Just one final important note. This discussion was put together with the help of AI, using the source material we mentioned. We aim for accuracy and insight, but some information might not be perfectly correct or fully up to date. Always do your own homework and talk to a qualified financial professional before making any investment decisions.